Now we go to the qualitative measures of credit control. Now till now we were studying the quantitative measures, and now we are going to do the qualitative measures or selective measures of credit control. Now what happens over here? Earlier, whatever changes the central bank takes, that is whether it increases or decreases the bank rate, increases or decreases the variable reserve ratio, all the sectors who take loan from commercial bank, that is industrial sector, housing sector, agricultural sector, individuals, they are equally affected. That means if central bank takes such a step that reduces the loan creating power of commercial banks, the loan flow will automatically be less to all the sectors. But in case of selective measures of credit control, suppose the central bank thinks that agricultural sector should receive more loans, it will take certain measures that will increase the loan flow from the commercials to the agricultural sectors, but it will restrict the loan flow to the other sectors. That is why it is known as selective measures of credit control. It only checks the quality of credit and it does not have the same effect on every sector who are dependent on commercial bank for loans. Now under this, the first is differential bank rate. Now what happens over here? Suppose commercial banks are giving loan to these three sectors: agriculture sector, industrial sector and housing sector. Now suppose commercial banks, central bank feels that there is a need to increase loan to the agricultural sector. So what they will ask the commercial banks to do? To give them easy loan. Easy loan means where the cost of taking loan is less. When the cost of taking loan is less, when the interest charged is less. That means, suppose the commercial banks are allowed to charge 10% interest from agricultural sector. That means if any loan is given to agricultural sector, they have to return principal plus 10% of principal. So this is the cost of taking loan. The amount extra which is paid back is the cost of taking loan. Now if the loan is given to industries, how much the industries have to give back? Principal plus 15% of it. And same way, the housing sector, if loan is extended, they have to give principal plus 20% of principal. So the extra amount, which is known as the cost of taking loan, is more for which one? The housing sector, because they have, whatever they take, they have to give 20% on that extra. And for which sector it is low? The cost of taking loan is low for agricultural sector. So when we go to shop in order to buy anything, we only try to buy those which are less costly. Similarly, if for agricultural sector the cost of taking loan is less, then only it will come and take loan from commercial banks. So in a way, the central bank, by dictating the commercial banks to charge differential bank rate, what does it do? It reduces the credit flow to all the sectors, but still agriculture can take more loans than the industries, than the housing sector, because the cost of loan is less. So here the central bank advises the commercial bank to go for difference interest rate charged on different sector, so that the sector where loan or funding is needed can take loans at a less costly rate, whereas sectors where central bank doesn't feel so much credit flow is required, the interest rate is high or cost of loan is high, because this will only indicate the housing sector to take less loan, because no one wants to take loan if the interest rate is high. So housing sector will definitely not take as much as loan like the agricultural sector, because here the cost of taking loan is more. So central bank, by advising the commercial banks to charge different rate of interest from the different sectors, it gives easy credit to some of the sectors and keeps the cost of loan less by keeping the interest rate less, and for some of the sectors the credit flow decreases because the cost of loan or interest rate is kept very high. Similar to this is margin requirement, but here what happens, now when we go to get loans from the bank, they don't know us, so they cannot give the loan for free. They keep a certain part of our security, collateral or security is kept with the bank. For example, if I am going to take a loan of 8 lakh rupees, I have to keep any valuables like either part of my property paper or gold as security, so that if I turn as a loan waiver, if I don't repay the loan, bank has sufficient cash or sufficient things of mine so that it can change into money and can suffer no loss as a result of me turning as a loan waiver. So definitely if I take 8 lakh rupees, I have to keep security 8 lakh or above that. And what happens if I don't repay? The bank will use the entire security that I have kept and it will encash it and try to take the principal amount back from there. So this margin requirement, it is kept high. That means if the banks don't want to give loan, they will not directly tell. What they will do, suppose if you want 8 lakh loan, they want you to keep 15 lakh security. So this is the margin requirement. Now why the margin requirement is so high? That means you will get only loan of 8 lakh if you keep 15 lakh worth security with the bank. So definitely a person who is in need of 8 lakh must not be having 15 lakh any security to be kept with the bank. He must not have that only. Or even if he has, why will he risk the entire 15 lakh in just for getting 8 lakh rupees? So margin requirement is often kept high, which reduces people's incentive to take loan. Two things can happen. Either they don't have 15 lakh worth security, so they cannot keep the security and that's why they cannot take loan. Or even if they have it, they don't want to risk the entire security with the bank just to take loan of 8 lakh. So higher the margin requirement kept with the banks regarding the security or collateral maintained against loan, lesser will be the incentive to take loan. It also means more is the cost of taking loan. So these are certain selective measures of credit control. Whereas if suppose the commercial banks or the central bank decides to give easy loan to someone, they will keep this security amount of less worth. So easy loans are available to some, whereas not so easy loans for the other. So selectively they are actually activating the credit flow and serving the economy. Now apart from this qualitative and quantitative measure, there is one more measure known as moral suasion. Now here what happens? Suppose what happens at home? Your father first, if you are going wrong, he will try to advise you, try to request you, and later on when you don't listen to this repeated advices, he will take some major step. Same thing happens over here. First, central bank understands how much loan should be generated to each of these sectors, and they advises the commercial bank where to increase the loan and where not to give loan. So the commercial banks have to listen to the advice of central bank because it is the apex bank or the head bank, and all the commercial banks fall under it. They have to be controlled by the central bank. Now if they don't listen to the central bank's advice or request, what can happen next? If the commercial banks try to only follow their own motive of profit earning, so if the central bank has directed not to give loan, but still they are giving on loans for the aim of making more profit and earning more interest income, then the central bank can take afterwards a drastic step of derecognition of the commercial bank. So what will happen? If the commercial banks do not follow the advice of the central bank, they might get derecognized and they will not be allowed to serve or operate as a bank in the long run. So moral suasion from the name. First, morally, the central banks tries to persuade the commercial banks what to do and what not, where to extend loan and where not. But if commercial banks listen to such advice, it's perfectly okay. But if commercial banks still keeps on its aim of profit earning, and how can it earn profit if it extends more and more loan? So even if central banks advise, the commercial banks are not paying any heed, and in order to maximize profit they are only generating loans for the aim of earning interest income, the commercial banks will be directed, ordered by the central bank to follow. And even if then also the commercials are not listening, the central bank might de-recognize them, and the commercial banks cannot be recognized as a bank later on. They cannot survive, operate in the market. So generally what do we find? The commercial banks do follow these request or advice of central bank because they want to survive in the long run. Profit earning is not their aim in the short run. They want to earn profit in for a very long period of time. That is only possible if they survive in the economy, and their survival depends on the hand of the central bank. So they try to follow the directives as laid by the central bank. So here we come to the end of the chapter, and all these measures, that is quantitative, qualitative and moral suasion, taken up by central bank is very important. The functions of central and commercial banks along with its difference is also important.